Paying off your mortgage early can give you a sense of financial freedom and potentially save yourself a ton of money in the process. But millions of homeowners get stuck paying interest for years, and it can feel like the door to financial freedom is slipping further and further away. Well, there is good news. There are strategies that you can use to take charge of your mortgage and potentially shave years off of your term of your loan. But with confusing mortgage terms and various fees, it can be hard to know where to begin. So in today's video, I'm going to discuss 5 strategies that are going to help you to pay off your mortgage faster. And if this is your first time here on my channel, my name is Jerry Pincus. I'm your real estate expert with over 20 years of experience. My expert team has helped over 2,000 people successfully move, and we know just about everything to help you to avoid those pitfalls that are costly. First, know what you're dealing with. Now, a lot of homeowners that I've met don't fully understand how mortgage interest rates really work. And this lack of knowledge can be a major roadblock to achieving financial freedom. So let's take a moment and understand how your mortgage interest actually is calculated. Now, mortgage interest is the fee that you pay for borrowing money from a lender, like a bank, and it's calculated as a percentage of the total loan amount, and it's called the principal. For example, someone takes out a mortgage for $300,000, which is the principal, and is a 5% annual interest rate, which means they pay that each year. So you're going to owe the lender 5% of the original $300,000 loan amount in interest. In the first year, that translates to 5% of $300,000, which is $15,000 in interest. However, you don't typically pay all of the interest right up front. Your monthly mortgage payment is divided into 2 parts. That's the interest and the principal. In the earlier parts of your loan, the larger portion of your monthly payment goes towards paying the interest, with a smaller portion going towards paying down the actual principal amount. And this is because the interest is calculated based on the remaining loan balance each month. So let's say that your monthly mortgage payment is $2,000. In the first year, a significant portion of that $2,000 might go towards the interest. For example, it might be $1,200 towards interest and $800 towards the principal. And this means that while you've paid $24,000 towards your loan over the year, $2,000 times 12 months, that's only $9,600 that has been towards the interest, since $1,200 times 12 months equals $14,400. And your loan balance has decreased by $9,600, not the full $24,000. It's more important to note that depending on the loan terms, the interest rate, and the total loan amount, that you could potentially end up paying more in total interest than the original principal amount borrowed. Now, this is more likely with a longer term loan, like 30 years, or even at higher interest rates. And mortgage interest is a significant cost that comes along with homeownership. Many homeowners don't even realize how scary this mortgage interest can be until it's too late. So paying off your mortgage can save yourself a ton of money over the long run. Now let's talk about 5 strategies that can help you pay your mortgage off faster. Number 1, making extra payments. Now, this is one of the most effective strategies to pay off your mortgage faster. In addition to regular monthly mortgage payments, try making an extra payment towards the principal amount. And this way you can reduce the amount of the outstanding principal on which the interest is calculated. Now remember, every dollar that you put extra towards that principal reduces the loan balance faster, which can bring you many benefits. You can have a significant savings in the total interest as extra payments, and this is going to shorten your total loan term. This means that you're mortgage free much sooner, and you're going to save money on the total interest that you would have paid over the long term. Now, you might be thinking, how much extra should I be paying each month? Well, this amount of the extra payment will vary depending upon your situation. Now, even a small extra amount that you put towards the principal each month can make a significant difference in the long run. Now, consider factors like your budget, your financial goals, and then decide the amount that you can comfortably afford to put into the extra payment. So you want to make sure these extra payments are applied directly to the principal balance, not just to cover your full interest payments. So be clear with your mortgage servicer that the additional amount should go towards the principal. Number 2, refinance. Now, refinancing your existing mortgage to shorten that loan term is another powerful strategy that can accelerate your mortgage payoff journey. And this involves taking out a new loan with a shorter repayment period, typically 15 years compared to the standard 30-year mortgage. Now, while refinancing often comes with significant higher monthly payment due to that shorter term, the potential benefits can be significant. Shorter loan terms give you an advantage as they come with lower interest rates compared to the higher loan terms. By refinancing a 15-year loan, you could potentially lock in at lower interest rates, which means a significant savings over the total interest paid over the life of the loan. For example, if someone has a remaining balance of $300,000 on a 30-year mortgage with an interest rate of 5%, the current monthly payment might be around $1,800. But refinancing to a 15-year loan with a lower interest rate of 4%, that monthly payment might increase to $2,200. The shorter repayment period of 15 years, though, on that loan compared to 30 years on that loan means you're mortgage-free much sooner. And this can free up a significant portion of your monthly budget and allows you to achieve other financial goals faster. Number 3, increase your monthly payment amount. Now, another strategy to accelerate your mortgage payoff is by increasing your monthly payment amount. Even seemingly small increase of payment over time can significantly reduce the overall loan term and save you a ton of money on the interest in the long run. Now, higher principal payment indicates less interest is being charged on that outstanding loan balance each single month. This can accelerate your payoff in the process and shorten the loan term even further. So if you have a 30-year mortgage with a remaining balance of $250,000 and a current monthly payment is $1,500, by increasing your monthly payment just $100 each month, your new payment would be $1,600. Now, this may seem like it's just a small increase, but it could shave off years off of your loan term. In this example, consistently paying an extra $100 a month could potentially help you to pay off your mortgage 3 to 4 years earlier. But increasing your loan payment will also require careful budgeting, so you want to make sure that you're comfortably able to afford that additional amount. And you may have to give up some of your spending habits and identify other areas where you can cut back. Number 4, consider lump sum payments. Now, making lump sum payments towards your mortgage principal is another effective strategy to save on mortgage interest costs. And this payment can come from various sources. It could be a tax refund, a bonus income, or even inheritance. A lump sum payment can reduce the amount of interest charged on a loan going forward. And this is because you'll have less remaining to pay on your principal, and the interest is calculated on your remaining principal balance. But it's important to consider your financial situation so you can maximize its effectiveness. Now, you may have a prepayment penalty or other debts which need to be considered. And the last strategy in this video has a lot of homeowners who don't know about this. Number 5 is making bi-weekly payments. Instead of the usual monthly mortgage payment cycle, you split your payments in half and you make payments every 2 weeks. And this method can be a game changer for your payoff journey if you're consistent enough. Think of it like this. With bi-weekly payments, you're essentially sneaking an extra monthly payment every single year. That's because there are more than 2 weeks in a month. Those bi-weekly payments don't get perfectly aligned with the monthly cycle. So this means you end up making one extra payment every single year, and that essentially functions like a mini principal repayment. And these extra mini repayments on your principal can chip away at your loan balance even faster. Now remember, a small loan balance means less interest is charged overall, so saving you a significant chunk of money in the long run. Now let us know in the comments, go ahead, what strategies you're personally following to shorten your mortgage payment. And if you found this video helpful, make sure you share this with someone that you know who could use it, because I'm making these helpful videos for you. And if you like these videos here on this channel, you can go ahead and consider subscribing and hitting that bell. I'm Jerry with Jerry Pincus Real Estate Experts. My real estate team is here to help you find your hidden gem and to avoid those pitfalls that are costly. So give us a call at 843-839-9870. And until next time, stay happy, stay educated, and I'll talk to you soon. Take care, guys.